Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello, welcome students. Today I want us to study about cash book. How to prepare cash book. How to prepare cash book. Preparation of cash book. Preparation of cash book, and we say that the cash book is the most important book of primary entry. The most important book of primary entry. The cash book is the most important book of primary entry, and you know what we mean by books of primary entry. We usually say the accounting cycle follows this process. We start with the source documents. Where the accounting process. The accounting process starts with the source document. When a transaction has been effected, we generate the source documents. And source documents include such things as receipts, payment vouchers, invoices, purchases invoices, sales invoices, and such. Now, once you generate the source documents, you list the source documents in the books of prime entry. You list the source documents in the books of prime entry. And we call them journals. So cash book is the most important of the books of prime entry. It is a journal. But a cash book acts like a book of prime entry and also part of the general ledger. It's also part of the general ledger. It serves the two purposes. And we know that the rest of the books of prime entry, includes sales journal, includes purchases journal. Now, what are these? When we sell any goods on credit, we record those goods in the sales journal. When you purchase anything on credit, we record it in the purchases journal. Now, these are credit sales and credit purchases. What about when we sell in cash? When we sell in cash, we record that whatever we sell in cash in the cash book. Whatever we sell in cash, we record in the cash book. Whatever we pay in cash, we record in cash book. So when it is on credit, sales on credit, we record in the sales journal. Purchases on credit, buy on credit, we record on purchases journal. But when we sell in the cash, we record it in the cash book. Cash sales, and cash payment. And by this payment, I mean payment either using actual cash or using money in the bank, using checks to pay, using the money in the bank. So we are saying there are very many books. They are here. We also have others like general journal. So cash book is part of the books of prime entry. Cash book is the most important book of prime entry. And therefore, we use the source documents to record in the cash book. So essentially, I like saying, a cash book, it is bringing together two accounts from the general ledger. It is bringing together two accounts in the general ledger, the cash account, and the bank account. This is the debit side of The debit side records all the receipts. The debit side records all the money we are receiving. Remember that the cash book is part of the double entry. Remember, the cash book is part. It is not just a book of prime entry, but it's part of the double entry. It's part of the double entry. So if we receive money from our suppliers, we will come here and we say date, details, date and details, date, details, cash book. So the same thing here, we say date on the credit side, details, and then cash and bank. Date, details, cash and bank. So if we receive money from a trade creditor called Peter, if we had a person called Peter, and Peter owed us through sales, if Peter owed us through sales, we had bought from Peter goods worth about 3,000. Good worth about 3,000. And now Peter gives us cash, 3,000 shillings cash. We do a double entry. In the farm, cash increases. The asset of cash increases. So we come here and we will debit 3,000. You come and debit 3,000, and we say the date is 1st of January 2025. And the date, we remember what we say, we cross-reference. We say, come here and say Peter account. And then within Peter account, we come and we say 1st of January 25, we say cash account. We say cash account 3,000. We are collecting debt from Peter. So we debit cash within cash book. And we credit Peter. Many a times when we are told to prepare the cash book, you are not told to prepare the other side of the entry. You're never taught to prepare the other side of the entry, but it's good to understand that cash book is part of double entry. Cash book is part of double entry, and this is now being done in the debtors ledger. This should be within debtors ledger. This is within debtors ledger. Now, if we have creditors ledger, and we have a supplier who supplied goods to us called Peter. Call him John. John is a supplier, and we made purchases worth 5,000. We made purchases worth 5,000, and therefore we debited purchases and we credited John with the 5,000. We debited purchases to record a purchase in the farm. We debited purchases in the general ledger, and we credited John with 5,000 to record a liability. Now, when we want to now pay John, we will come here and we say on 2nd of January 2025, and the corresponding account is John account. John, please note what I'm doing. We are saying it is John account. We are paying John. Assume we are paying John with the money we have received, 3,000, and we are paying him in cash. We're not saying paying through check. We are paying him in cash. We will come here and we go to the cash column and we say 3,000. So we credit cash, because when we pay, our asset of cash goes down. And a reduction of an asset, we credit the asset account. So we come and we credit cash. And we debit John. We debit John with 3,000, which is reduction of a liability. A reduction of a liability, we debit the liability account. A reduction of a liability, we debit the liability account. And then we cross-reference the description. Here we say John, but here we say cash. You say cash account. And we get the date to January 25. 2nd of January 25. Now, we record both the receipts. The receipts of both cash and checks. We record receipts of both cash and checks. Assume we have a customer called Mogoroki. We have a customer called Mogoroki. Mogoroki came and bought from us. We sold on credit to Mogoroki an amount. So we credited sales and we debited Mogoroki an amount worth 200,000. We sold to him an amount worth 200,000. So we credited sales and we debited Mogoroki. We credited sales to record a sales income, and we debited Mogoroki to record a receivable from Mogoroki of 200,000. And on 3rd of January, Mogoroki now brings us a check. Mogoroki brings us a check. He's not bringing us cash, he's bringing us a check. He's bringing us a what?
Check.
He's bringing us a check of 200,000. So remember double entry. Remember the rules of a double entry. Our money in the bank will increase with 200,000. Our money in the bank will increase in 200,000, but our receivables, our data will decrease with 200,000. Our data will decrease with 200,000, and then we do what? We cross reference. We cross what? We cross reference. In Mogoroki we say bank because it's not going to cash because this is a check. And in bank we say Mogoroki. We say who? All of them we are saying account because it describes the corresponding account. In Mogoroki we are saying bank account. In cash we are saying Mogoroki account. We are not just saying Mogoroki, we are saying Mogoroki account, A/C. And then we capture the date. The date is 3rd of January 25. We come here, we say that of January 25. We are recording a receipt of a check, so we debit bank. At an increase in an asset, we debit the asset account. And our asset account here is bank. We receive a check, we are not receiving hard cash, we are receiving a check. So we come and we debit bank, and we reduce our receivables with 100,000. We reduce our receivables with 100,000. So we're basically saying we are receiving both cash and checks. We are receiving both cash and what?
Check.
And checks. We are receiving both cash and checks. There is any receipts and any payment. You can have a situation whereby we are buying. We want to buy motorbike. We want to buy a motorbike, and we are buying a motorbike worth 50,000. We are buying a motorbike worth 50,000. So we create an asset called motorbike account, and our asset of motorbike will increase, and an increase in an asset we debit the asset account. So we come and we debit motorbike with 15,000. As we reduce our money in the bank, we are giving a check, we reduce our money in the bank. So a reduction in an asset, we credit the asset account. So you come to bank and we credit the bank with 50,000. We credit the bank with 50,000, and we now do the cross reference. In the bank, we will say motorbike, we will say motorbike account, and in the motorbike, we say bank. We say what?
Bank.
We say bank account, and we capture the date. The date is, assume it is 5th of January 25. Assume here it's 5th of January 25. We are not just paying creditors, we can pay anything in the farm. We can pay anything in the farm. For instance, assume we are paying we are paying a loan. Assume we are paying a loan. Assume we had received a loan amounting to 10,000. We had received a loan amounting to 10,000, and we have received a loan. So our balance brought down is 10,000 of the loan. If we are paying the loan of 10,000, our money will reduce. Our money in the bank, we give a check of 10,000. Our money in the bank, a reduction in asset, we don't debit the asset account, we credit the asset account. So our bank is reducing with 10,000. Our bank is reducing in what? 10,000, and we are paying a loan, so loan account. Always, some students are very good at identifying which account, but they leave without saying A/C. You must say A/C, account, and then you get the date. And you get the date, it is 10th of January 25. And here you get the date is 10th of January 25, and you're saying we are paying the loan through bank account, and you are saying 10,000. And you're saying what?
10,000.
We are saying 10,000. You must know that usually in a cash book, we have some money at the beginning of the period. So you may say 1st of January 2025, we have a balance brought down. Please mark this, that cash may always be positive. May always be positive. Will always cash be positive. But the bank can have a positive or negative balance brought down. We're saying that the bank could have a bank overdraft. So if we had a bank overdraft, we will go to the credit side of the bank. You go to the credit side of the bank and you say balance brought down. The beginning balance is 10,000. Now we are saying, remember, an asset has a debit balance, a liability has a credit balance. So if you are told that a cash book has an opening credit balance of 10,000, you don't bring the bank to the credit side, you don't bring the balance to the debit side, you bring the balance to the credit side. You bring the balance to the credit what?
Side.
You bring the balance to the credit side. That is very, very, very important. Take care to know the opening balances for the bank. Is it credit or debit balances? If it is debit balances, bring it to the debit side. If it's a credit balance, bring it to the credit side. Bring it to the credit side. Bring it to the credit side. Bring it to the credit what?
Side.
Bring it to the credit side. Now, you will realize that this is a two-column cash book. These are what? Two-column. Cash, we call it two column because it has cash and bank column, cash and bank column, two columns. It doesn't have the discounts account. It doesn't have the discounts what? Account. And therefore, at the end of the period, maybe on 31st of January 2025, if there are no other transactions, we are supposed to get the totals. We're supposed to get the totals, and we are saying, this one, the total is 13,000. The total is 13,000. And this one, the total is how much? 200,000. Now, because this is an asset account, we usually look at the debit side to find out, is the debit side bigger than the credit side? You may find for the bank, the credit side is bigger than the debit side, meaning it's a bank overdraft. What's a bank overdraft? It is where the bank pays on our behalf more money than the money we have in the bank, so that in short, the bank is giving us short-term credit facility. It is loaning us money. It is loaning us money. A bank overdraft is where a bank loans us money to use to pay our creditors in the short run, and immediately money hits our bank account, the bank recovers its money. The bank recovers its money. So we have a balance. This is supposed to be 13,000, and this is supposed to be 200,000. It's supposed to be 200,000. So we say that the 1st of January 25, balance carried down. Balance carried down. We add the debit side, we subtract the credit. The debit is 13,000. We subtract the credit of 3,000 for the cash column. We look at cash column here vis-a-vis the cash column here. The total for cash column is 13 minus 3, so the balance is 10,000. The balance is 10,000. So we are saying we corrected. We have the money had at the beginning plus the money collected because of the month is 13,000. Out of 13,000, we spent 3,000 and we were left with 10,000. The money we have as the closing balance plus the money we have, the money we spent, equals the money we had. On the bank column, we have 200,000 minus 60, 70. 200 minus 70, we get 130,000. 130,000, meaning we have a bank balance of 130. Although at the beginning we had an overdraft of 10,000, we have been able to pay that overdraft of 10,000 with our huge receipt of 200,000, and we still have a balance of 130,000 shillings in the bank. 130,000 shillings in the bank. So you realize that a two-column cash book is just combination of the cash account in the bank, in the general ledger, and the bank account. So please note this. We remove the cash account from the general ledger and the bank account, and we generate a different document called two-column cash book that acts as part of the general ledger. It acts as part of the general ledger. It acts as part of general ledger. It acts as part of what?
General ledger.
General ledger. And for that reason, I'd want us to quickly do a question. I'll be explaining to you the description of the question. I'll be explaining to you the description of the question. So we do the question together. We do the question together so that we can know, are we able to understand how to prepare a two-column cashbook? How to prepare a two-column what?
Cashbook.
How to prepare a two-column cashbook. How to prepare a two-column cashbook. So we will do one for two-column and then we'll do another one for three-column. So let's look at a two-column cashbook. So you are told, write up a two-column cashbook for the following details and balance off at the end of the month. In 2025, 1st of May, so we say two-column what?
Cashbook.
Two-column cashbook. Two-column
Cashbook.
cashbook. Two-column cashbook. Two-column cashbook. It's not a cashbook account, it's two-column cashbook. So we have cash and bank. We have cash and what?
Bank.
Cash and bank. We have cash and bank. We have cash and bank. And we usually have date, details. We have date, details. So we're talking on 1st of May, as started business with the capital in cash of 1,000 pounds. 1st of May 25, started business with capital in cash 1,000. So this is capital. So the owner has brought in money. The owner has brought in what? Money. So there's an increase in capital, and an increase in capital, we credit the capital account. We credit the what?
Capital account.
Capital account with 1,000. We credit the capital account with 1,000. So, and we are told in cash. So we are receiving cash, 1,000 pounds. We are receiving cash, 1,000 pounds. So capital. So we are debiting cash as we credit capital. Remember, we are required to just prepare the two-column cash book. And because we have just been required to prepare the two-column cash book, this is not important. Don't waste your time giving information you are not told to give. So we know we will debit capital account. We will debit cash account as we credit capital. As we credit what?
Capital.
On 2nd of May, paid rent cash 100 pounds. On 2nd of May 25, we paid rent. The corresponding account is rent account, and we paid 100 in cash. We paid 100 in what? It was not in bank, it was in cash. It was not check, it was cash. It was cash. So we debit rent expenses account and we credit rent account. We credit cash book. We credit cash. We credit cash account. We credit cash account. We debit rent expenses account as we credit the cash. As we credit the cash account. Or the cash column, we record the payment. On that of May, F. Flake lent us 5,000 paid by check. So our bank increases, and an increase in bank, we credit the bank account. We debit the bank account, we don't credit. We debit the bank account, we don't do what? Credit. And we are receiving the money from F. Lake. We are receiving the money from F. Lake. So F. Lake account on 3rd of May. 3rd of May. Now 25. So this is a loan we are getting. It's a loan we are getting. So we debit bank because an increase in asset of bank, we debit bank and we credit F. Lake account. We credit F. Lake account to record a liability. To record a what? A liability. On 4th of May, we paid B. Mackenzie 650 by check. So anytime we say by check, we mean bank. We mean bank. Our money in the bank reduces. A reduction in an asset, we credit the asset account. We are paying B. Mackenzie. The B. Mackenzie. That is somebody who we owed money. B. Mackenzie account. We credit B. Mackenzie account with 650. And the date is May 4. 4th of May 25. So we are paying somebody, we are paying an expense, we are paying something we had incurred from B. Mackenzie. So we debit B. Mackenzie to reduce the liability as we credit bank to record a reduction in our money. We are paying somebody we owed money. We are paying somebody we owed money. A reduction in a liability, we debit the liability account. We debit the liability account as we reduce the asset of bank. So a reduction of an asset, we credit the asset account. Now we are told on 5th of May, we made a sales. 5th of May, we made a sales. And therefore the corresponding account is sales account. The corresponding account is sales account. We made cash sales. We made cash of 980. So it is cash. Our asset of cash increased with 980, and an increase in an asset, we debit the asset account. So we debit cash as we credit sales. So always say account, because you are describing the corresponding account. Because you are describing the corresponding what?
Account.
On 7th of May, we paid N Mira by check 620. We are paying N Mira by check. We are not paying by cash. We are paying by check, meaning through bank, and we are paying somebody called N Mira. We are paying N Mira. We are paying N Mira. So N Mira account on 7th of May. On 7th of May. On 7th of what? On 7th of May. So we are reducing our money. So we credit bank with 620, but we are also reducing our liability, because as we credit bank, we debit N Mira to reduce the liability. A reduction in the liability, we debit the liability account. On 9th of May, we paid B Baton in cash. We are paying B Baton in cash. A reduction in an asset of cash, we credit that cash account. So our cash is reducing. It's not bank this time. Our cash is reducing with the 220, and we are paying B Baton. We are paying who? B Baton. B Baton. We are paying B Baton account. We are paying B Baton account on 9th of May. 9th of May 25. 9th of May 25. Then we are told on 11th of May, cash sales paid direct into the bank. Cash sales paid direct in the what? A customer went and paid money into our bank amounting to 540. Our bank is increasing with the 530. Our bank is increasing with the 530, and it is being paid by direct. So we say sales account. We say sales account. We credit sales as we debit bank. We credit sales as we debit what? 11th of May 25. 11th of May what? 25. On 15th, Gmore paid us 650. 650. Gmore paid us 650 in cash. So our cash increases with the 650 from Gmore. Our cash increases with 650 from Gmore account, and therefore 15th of May 25. So we are saying we are receiving money from Gmore. Gmore most probably was our debtor. And as he pays us, our cash increases with 650, an increase in the asset of cash, we debit the cash account, and a reduction in the receivable, we credit the Gmore receivables account. We credit the Gmore receivables account. On 16th of May, we took 500 out of the cash till and paid it into the bank. We are removing money from cash. So a removal of money from cash, a reduction of cash, we credit the cash account. We credit the cash what? Account. This is very, very important. We are crediting the cash account, but we are taking it to bank. We are taking it to what? Bank. We took it to bank. We took it to where? Bank. To bank. So our cash in the office reduced, so we credit cash with the 650, but the money in the bank is increasing. The bank is increasing with 650. Sorry, with the 5, this should be 500. 500. So our money in the bank increases with what? 500. And we say it is coming from cash. That's a very important entry. And it confuses students. We are saying we are reducing our cash in the office. A reduction of cash, we credit the cash account. So we credit cash with 500. But where are we taking the money? We are taking the money to what? Bank. To bank. We're taking the money so our bank increases So an increase in the asset of bank, we debit the bank account. An increase in the asset of bank, we debit the bank what? Account. The date is 16th of May. The date is 16th of May 25. 16th of May 25. Then we are told on 19th, we repaid F. Flake 1,000 by check. He gave us 5,000. Now we are paying him. So our money in the bank is reducing with the 1,000. A reduction in the asset of bank, we credit the bank account. We credit the bank what? And we are paying F-Lake account. We are paying F-Lake account. We are paying F-Lake account on 19th of May. On 19th of what?
May.
On 19th of May 25. We are paying F-Lake account on 19th of May 25. So we are reducing our money in the bank. We are reducing our money in the bank with 1,000. So we credit bank and debit F-Lake. F-Lake is a loan. So as we debit the loan, a debit of our liability account is a reduction of that liability. Then we are told cash sales paid direct into the bank 660. Our bank is increasing. Our bank is increasing, and it is increasing because of the sales account. Is it because of the sales of what? So we are debiting bank as we credit sales. As we credit sales on 22nd of May 25. 22nd of May what? 25. On 26, we paid motor expenses by check 120. Our money in the bank reduces with 120, so we credit bank, and we are saying the expense is motor expenses account. Motor expenses what? Account. And the date is 26th of May. 26th of May. 26th of May 25. 26th of May 25. So the two entries don't have to be in the cash book. Remember that cash book is part of the double entry system. Cash book is part of the double entry what? System. When we pay an expense, we debit the expenses account and we credit the respective cash account. We credit the respective cash account. We are told on 30th, we will withdraw cash from the bank for business use. We will withdraw cash. We are getting money from the bank and we are bringing it to cash. We are bringing it to cash. We withdraw 1,000 from the bank for business use. We withdraw 1,000 from the bank for business use. So we are reducing bank with 1,000 and we are taking it to cash. We take it to what? Cash. To cash. We take it to cash, and that is on 30th of May. 30th of May. 30th of May 25. We are reducing money in the bank as we increase cash. So our cash is debited with 1,000. Our cash is debited with 1,000 because it is increasing. The money in the office is increasing, and an increase in an asset, we debit the asset account. An increase in an asset, we do what? We debit the asset account. 30th of May 25. Here we say it is coming from bank. It's coming from what? Bank account. It's coming from bank account. On 31st of May, we paid wages in cash 970. We paid wages in cash 970. 31st of May 25, our cash reduces, and a reduction in the asset, we credit the asset account. So we come to the cash column and we credit cash with 970. We credit cash with 970, and you know that the corresponding debit, this one we will say the corresponding account is wages. We say the corresponding account is what? Wages. In other words, we debit wages, expenses account with 970, and we credit cash with 970. We credit cash with 9 what? 70, and that is the end. That is the end. So always remember that the bank column can have a debit or credit balance, but the cash will always have a debit balance. The cash will always have a debit balance. So if we add them up, this is 1980 plus 650 plus 1,000, we get a figure of 3630. The total amount of money is 3630. The total amount of money received is 3630. 1980 plus 1650. 1650. The total received is 630. We subtract the cash. The total cash column here, subtract the total cash payments. Minus 320, minus 100, minus 220, minus 500, minus 970. We get 1840. That's the balance at the end of the year. That's the of the month. That's the balance at the end of the month. So 31st of May 25, we say balance carried down. Balance carried down. Before you work on the bank column, you must ask yourself which side has more. which side has more. And automatically you can see this side has more because this is already 5,000. This is already 5,000. And even if you the three of them become 1,500, it will be 6,500. This side you have only 2,000, so this side has more. You are lucky that the debit side has more. 5,000, 55, 30. So 60, 30, 60, 30, 60, 30 plus this is 10, 30 plus 5,000. This and this is 10, 30 plus 5,000 is 60, 30. 60, 30 plus 660. That gives us 6690. 6690. 6690. We subtract all the bank payments minus 650, minus 620, minus 1,000, minus 120, minus 1,000, 1, 2, 3. We get a balance of that 300. You get a balance of that 300. You get a balance of that 300. This becomes that 630. The total here is the same as here, that 630. The total here, 6690, is the same as the total here. That's how to prepare a 2-column cash book. That is how to prepare a 2-column what?
Cashbook.
Cash book. That's how to prepare a 2-column cash book. Thank you.